let's dive straight into our first panel discussion for this afternoon. Views from CIOs. Should I be concerned about market volatility, or how concerned should I be? I think many of you might agree with me. It's not easy being an investor these days with the amount of news, noise, and everything else in between. In this session, our esteemed panelists will tell you how they, as chief investment officers of their organizations, are capitalizing on the opportunities and managing the challenges in the upcoming year against the backdrop of rate cuts, geopolitics, and market swings. This session will be moderated by Endowus Chairman and CIO Samuel Reed. And I'd like to invite our distinguished panelists to join Samuel on stage right now. From the CFA Society Singapore, board member Anubhuti Gupta, CFA. Please join us on stage. Next, from AIA Singapore, she is the Chief Investment Officer, Chunyan Liu. And last but not least, from Templeton Global Investments, he is the Chief Investment Officer, Manraj Sekon. All right, Sam, all yours.
Thank you, Ryan. And we are going to kick it off, guys. We have a panel of amazing speakers. I'm going to let them actually introduce themselves and maybe a brief comment to introduce your firm, what you do there, and maybe you can also share what your ties to Endowus may be, just for fun.
Oh,
and yeah, let's start. Ladies first.
Thank you. We have two ladies, but I'll go first.
Alphabetical order after that, yeah.
So thank you, Sam. It's a pleasure to be here. I'm Anu. I'm a senior principal with Mercer Investments in Asia. Now, Mercer, as you may know, it's a global consulting leader in talent, health, and investments. And our investment practice is actually the biggest in the world, both by assets under management as well as assets under advisory. So basically what we do is we specialize in tailored investment solutions and strategic investment advice to institutional investors across the world. Prior to joining Mercer, I spent almost 20 years in the asset management industry, and I was Chief Investment Officer for Asia and emerging market quantitative equities at AXA Investment Managers. So in terms of my ties with Endowus, I'm really sort of inspired after hearing more about Endowus, and in a personal capacity, I will definitely have some ties very soon, but we also do hope to work with you in a more professional capacity.
Absolutely, and the CFA Society, the reason Anu's title is just CFA and not mentioning the M company officially is because she's actually on maternity leave. Still, so she's just recovering from congratulations on your
so much,
arrival of a new loved one. A lot of people were commenting on my knees and how, courageous or whatever I am, doing this. But anyway, thank you so much. Yeah,
it's my pleasure. Thank you.
Doing this. Chunyan, over to you.
Sure. Thank you for having me here, Sam. And afternoon, everyone. I'm Chunyan Liu. I'm the Chief Investment Officer from AIA Singapore. Anybody knows who is AIA?
Maybe a few people might know.
Well, it's just
most of them are more familiar with Endowus, so I don't know.
I'm sure. We are now 90 plus years in Singapore. It's a life insurance company, Pan Asia, 18 markets. I'm the CIO actually for AIA Singapore, AIA Brunei. We are life insurance majority of the business is life insurance. Of course, our investment-linked products also is a key strategy and key line business for us. I manage 40 billion Sing dollar under asset management, and around 10 billion right now as of today under investment-linked products. I hope some of you are our clients. We are an insurance company that's probably the largest lifer in Asia and widest footprint. So if you talk about investments, it's as wide as insurance products we have. And we love serving our policyholders in Singapore. We have about 1 million retail customers, policyholders, through our corporate group life business. We have probably another 1 million policyholders, some overlapping here and there, so about 1.5 million policyholders in Singapore. That's it. So that's AIA Singapore. What I do as an chief investment officer, of course, manage all the assets. I'm also in charge of our property management as well as sustainability department as a corporate level. Ties with Endowus. always inspired by Sam and what Endowus do for the industry, for people here in Singapore. The digital development, advancement that Endowus brought to and contributed to Singapore as a whole is remarkable. And how you actually integrate the ecosystem horizontally, vertically is also bar none. So that's a lot of inspiration we draw from Endowus. We have a close watch of how you're doing and conducting your business, the funds you have onboarded, and how you approach the customers, how you update the clients here. A lot of things we can learn from in terms of communication and promote the transparency and touch points with retail customers here. Personally, of course, good friend, Sam is my good friend, and always very happy to be here and share a bit about investment insights with all of you here. Thank you.
Yeah, it's our second year, Chen Yan, so thank you so much for being here for us. Manraj, over to you.
Thank you. Well, first of all, thanks for having me, and congratulations on this event in half a decade, half a billion.
Love it, yeah.
So I'm from Franklin Templeton. Franklin Templeton is an American-based global asset manager. We manage over $1.5 trillion of client assets globally. We have clients in about 130 countries around the world. I take care of the Templeton equities business for Franklin Templeton globally, so that covers developed markets, emerging markets, Asia, right around the world. Within that, we have public equities, we have private equity as well, so quite a range of strategies. I'm CIO of that group. We have a fantastic team around the world who manage assets on the ground, but I oversee that group. In terms of Endowus, a very valued partner. We are on the Endowus platform, I'm pleased to say, and it's been very successful for us. Thank you to the Endowus team. So that's the key relationship. And a separate part of Franklin Templeton, which is our strategic ventures business, is also a shareholder in the Endowus group, and I think they're very pleased with what they're doing there as well. So thank you.
Fantastic. Thank you so much, guys. And it's very, very special that we have three very distinct speakers. One from the fund management industry, Chen Yan from the insurance asset allocation, and then Anu from an investment consultancy advisory, and then obviously her role in CFA brings different perspectives. So it's amazing that we can have this quality speakers. So let's dive in, guys. So Chen Yan, let's start with you. Why don't you kick us off with maybe an overarching view on the macro and kind of market outlook as you see it?
Sure.
In your role as CIO, and then briefly touch on your preferred asset class as well. Yeah.
Sure. Thank you. Thanks for the question. So beginning of the year, we thought China would recover. We were not entirely correct. Beginning of year, we thought we would see the rate cuts happen, quite a few this year. I remember still like beginning of year, we were thinking 4 times this year, 3 times next year, total 7 times. Now we finally see 1. Also beginning of year, we talk about US recession. Actually, we talk about that since last year. So how wrong were we, right?
Wow, such humility. Not many people speak like this, guys, so I'm shocked, but yeah, thankful, thank you. Wow, such humility.
We are not alone in those views.
Yes, that's the other thing. Everybody got it wrong.
You're humble on behalf of everyone, right?
Thank you. I mean, the truth is, you can never call the market precisely as you would want it to be. And the scenarios usually is a direction. And anybody who told you that they can call the timing, the direction precisely, they won't be there talking to us. Even Warren Buffett said that you just need to be 51% correct. You'll make the most of money, right? So that's how hard it is. But it also shows that on top of all the scenarios we look at, a lot of other things also happened. The war in Europe or Middle East, some tension here and there between China, US, China, Taiwan. A lot of other things also happened. And on top of this, we have a lot of elections that happen this year. And the model of all elections will happen in 2 weeks' time, or a week and a half time. So we'll see. What I'm trying to say is that macro views is always a direction. Yeah, rate cuts, it's a direction. When we have content inflation, when we have a more mild growth in terms of economy, there's supposed to be some rate cuts, so it's a direction. China, we hit the bottom last year. things can go, can plateau from here. That's what I'm trying to say. But with the government stimulus, it will be better, but it's a matter of time, right? So it's a direction. It's hard to call the market. That's why asset allocation is so important, because it's long term. You can't call the market correctly in terms of a precise timing. But the 6 to 12 months view could be one view that's closer to what's happening right now. 3 to 5 years view is always what life insurance companies are focusing on, because we're managing all the policyholders' money for your insurance policies. We have to deliver the commitment. So the midterm, which is 3 to 5 year allocation, is important. Having said all this, what I'm trying to convey the message is that it is important to focus on the long-term asset allocation, that what Sam and Greg were talking about, to fulfill your expectation. There is a problem statement you have. Everybody has for your personal balance sheet. I want to buy a house, 3 to 5 years time, my children's education, how much money I will need. Hence, you set your financial goal to fulfill those needs. Life insurance company, the same. We look at our investments from product group perspective. We have long-term products, we have whole life products, we have shield plans, which is hospitalization and medicals and whatnot, has different time horizons, has different commitment levels, which we have to set different risk tolerances. Hence, that gave us the risk appetite, how much equity we can take, how much illiquid assets we can take. So that's asset allocation that comes into play. The view, coming back to the question, the view right now is that there are regime changes as we observe. China might be going through revaluation. We are saying that it's a bottom, but we don't know exactly how long it will sustain in the current state. So it's a revaluation that's going on. US, everyone talk about being very expensive, but if you look at all the earnings, might not be so expensive as we initially thought. So that's a revaluation that's going on. So regime change. In this period of time, it's important to select the asset allocation that's focusing on long term. It's also important to select the fund managers who can be quite nimble and flexible, and who can be successful in regime change capital market environment. Favorite asset class is as difficult as picking my favorite movie, but I'll give it a shot. I think fixed income for me, for now, because it's very versatile. We can talk a bit about that later, given that it has a lot of different sub-asset classes. It has guaranteed portion, it has non-guaranteed portion. It can be pretty different permutations, can be long-term, can be short-term. So for insurance companies, majority of our asset class is in fixed income. That meant to be my favorite asset class.
Great. No, thank you. And that sets up nicely for Anu to maybe follow up on your views, because you're a generalist, you actually have experience in multi-asset classes, and so your preferred asset class. We've ascertained that we're in a new regime, right? So as Chinyan said, we had elevated interest rates for many years now at very high levels that we hadn't seen in 20 years, right? And we're coming off of that with a bigger than expected cut, 50 basis points, but with the market assuming now that actually maybe it's not going to fall as much as we had hoped. So that's a regime, but it's also a direction, as Chinyan said. And then growth is slowing. It is slowing. Inflation is coming down, but it's not as coming down as fast as maybe as many people had expected. So again, Chinyan's humility, but everybody's humility now, because everybody kind of got that wrong. And that's why Endowus doesn't really focus on trying to get the market right, what the next month is about. But yeah, your views on each of these asset classes, where we stand in the cycle, would be really great, your assessment.
Absolutely. So first I want to say I totally agree with what Chunyan and Sam said. You need to take a total portfolio view. You need to focus on what your needs are and what kind of portfolios you should be building for the long term. It could be that you may have some short-term liquidity needs. So obviously, by all means, for that segment, to match those liabilities, you can build something that is more short-term focused. But I absolutely agree, it's very hard to get market timing right. So it's important to take a long-term strategic view for your long-term goals that you're trying to accomplish. Now, having said that, of course, as we move through cycles, there are short-term disruptions. And if you have the time, if you have the knowledge, if you have the right governance structure and discipline, you can benefit from those. So with that as a backdrop, I'll talk about the different asset classes in the new regime that we are finding ourselves in. Now, obviously, we do see that rates have definitely peaked, and they may be coming down, but the easing cycle may not be as accelerated, as pronounced as we originally thought it to be. And you're right, Chunyan, a lot of people, including ourselves, we got it wrong. So having said that, like even if, let's say, the rates start easing, we do not believe that they're going to go back to the levels, the very low levels that we have gotten used to over the last many decades. So what that means is that the risk and return trade-off has become smaller, which is, in simple terms, you are not going to be rewarded with a lot more return for taking on that extra unit of risk. And against that backdrop, fixed income becomes even more important and attractive as an asset class for you to hit your investment return objective without taking as much risk as you had to, say, 2 years ago. So fixed income is an important asset class. Definitely take a look at it. What we see in institutional portfolios is people have taken on a lot of risk. They have a lot of equity risk, which they don't need anymore because of the way the markets have moved. So fixed income is important, and how you structure that allocation is also very important. And I mean, I don't want to speak too much about how you should build that bucket, but we can discuss that later. Now, moving to the next big asset class, equities. Overall, the macroeconomic environment still remains favorable for equities. Like, we believe that the economy is slowing, but it's going to do at a gradual pace, soft landing, as people say it. Overall, the earnings that the companies are reporting remain rather resilient. But at the same time, what we are seeing is valuations are somewhat stretched, and the technicals are also no longer as attractive as they used to be. Plus, as we approach year-end, there are several uncertainties that are building into the market, namely the elections, geopolitics, and so on and so forth. So against that backdrop of increased volatility, we would like to be, I would suggest that be more neutral to slightly overweight in equities is a good place to be. Now, the other asset class that I really want to talk about is private credit. Mm-hmm. So that's one of, I would say it's my favorite asset class, because with private credit, it has delivered really strong risk-adjusted returns over different market cycles with very low volatility. And interestingly, contrary to what you may think that it's more risky, the default rates are going to be higher for this versus the public bonds, that's not the case. We have done an extensive analysis, and I can tell you that the default rates are actually slightly lower than investment grade. There are better protections for the lenders. And in fact, like, the yields are very attractive. You can expect almost 10 to 12%. And the income distribution is also very attractive. So with all these things, taking all these things into consideration, private credit is a very attractive asset class for any investor to consider. And finally, I talked about total portfolio approach. So what that means is you need to build robust portfolios that can last through different market cycles, and you have some protection when things kind of don't pan out as you expected. So obviously, having equity, fixed income, private credit, it gives you some diversification. It provides some downside protection. But if you really want to make a robust portfolio, we would suggest that you look at hedge fund, more alternative investments like hedge funds. And we know that hedge funds have been out of favor for a while, given the rates were so low. But hedge funds, you can think of it not so much from a return perspective, although that may be changing because now the rates are, we are in a somewhat higher rate regime. But almost think of it as portfolio insurance. They protect, they buttress your portfolio's downside when things are not going right. So 2022 is a great example where bonds and equities were correlated positively and did not provide the kind of protection you wanted. So their downside protection can be offered by certain hedge fund strategies.
Okay, wonderful and comprehensive. But we're going to hone in on a single asset class with Manraj. Equities is still front and center in everybody's mind. It's a core allocation to every retail investor's portfolio. So equities, developed markets, historical high, highest valuations. And then you have emerging markets, which have really underperformed. But you're seeing a very strong rebound in China and some of the markets. And so at this point in the cycle, what are your views on the equity markets and where do you see the opportunities?
Sure. So I think it's important, Sam, when we talk about equity markets, we break it down, right? So on the one hand, you have US equity markets at an overall level at historic highs, valuations as well. But what is true in the US and around the world is that this cycle has been very, very different. First of all, we're talking about a very extended cycle that began at the end of the previous decade with the GFC. You had very low interest rates for a long time, ultra loose monetary policy, and then you had the advent of COVID over the last few years. So there have been a lot of very unique factors driving the market, taking us to where we are now. Now, if you look at the returns that the market has provided over the last couple of years, as many of you know, it's been very narrow and concentrated largely in a small number of stocks, what is famously referred to as the Magnificent Seven in the US, and a few others. And just in the year gone by, soon about to end, over half the returns of the S&P are accounted for by the top 10 stocks. So you're talking about 10 stocks out of 500 reflecting more than half the returns in the biggest economy in the world, in the biggest market. So what's happening outside of that? And I think this is a very important point. And if you look outside of that, the rest of the market, the mid-sized companies, certain sectors and industries that perhaps have not been in as much favor. If you look at the small cap space, if you look at markets outside of the US like Europe, Japan, China, notwithstanding a very sharp bounce in the last few weeks, a lot of those markets have actually been left behind. So nothing changes the fact that the US remains the largest, the most important, the most innovative economy in the world, and that drives a large part of sentiment, of valuation, of interest. But I think it's important to recognize what's happening elsewhere. So turning to the rest of the world, well, first staying with the US for a second, I think what we've seen in the last few years, this very extended cycle, and I think we know it from our own experience, is that this has been what I would describe as a very bifurcated economic cycle. So you've got a number of companies that have done extremely well, that have had excellent market positions, great products, extremely well positioned, and you've got a large number of companies that have suffered from disruption, from technological change, from their end markets actually going through quite a bit of difficulty. Europe is a good example of that. What's happened in China in the last few years is another example. So the experience of really strong economic growth, the experience of really strong, consistent earnings growth is not a universal one. It hasn't happened everywhere. So there's a large chunk of the US market, and indeed the consumer. Obviously, the consumer at the very high end has had an extremely favorable backdrop for the last few years, but that's not true for the rest of the economy. The same is happening elsewhere. Europe has been going through its own challenges, fiscal, geopolitical, economic, reform-oriented, and as a result, that market's been left behind. There have been pockets of Europe, the large global luxury goods companies, the healthcare companies, pharmaceutical companies, they're very global in orientation that have done well, but again, a large chunk of the market has not. And then moving to the emerging world, Sam talked about China. We'll come into China in a bit more detail in a second, but China is going through its own transition right now, and you've had a huge bounce over the last 4 weeks, 20%, but you're talking about a market that was trading on less than 10 times earnings, now trading on maybe 12 times earnings. So it's hardly a fairly valued market, leave alone an expensive market. So when you look around the world, I think there are a lot of pockets of companies, of sectors that have been left behind, and I think it's an important time, and we are doing that to ensure we allocate with a view of which areas are still attractive, which areas have not had a lot of optimism reflected in them, and where we can still find opportunity. And we still believe there's a lot of interesting opportunities in the US. The other market, which I think stands out for us, is the broad emerging market space. The interesting thing about the emerging markets is, we conveniently use a label for them as emerging markets, but they couldn't be more different, right? China is very different from India, is very different from Southeast Asia, is very different from South America, but there are interesting opportunities in a lot of these markets. There's a lot of optimism about India. I think most of it is well-founded, and I think India will continue to have legs, notwithstanding an already very strong run. The other market that stands out is Brazil. Brazil is still seeing real interest rates at double digits levels, and an economy that's suffering because of that. Brazil is still one of the largest emerging markets. So I would say, we can talk about Fed funds policy. We are less optimistic about the scope for loosening and have been for some time. But in the event of significant loosening of Fed policy, I think that benefits markets like Brazil, that benefits markets like the rest of the emerging world. And the last thing I'll say about the emerging world is, in the last 3 to 4 years, you've seen significant Fed interest rate hikes. You've seen conflicts, obviously, in Russia, Ukraine, commodity price increases, higher inflation. What has been very interesting about the emerging world is that it has actually behaved in a very resilient way through this period. If you look at previous cycles, when you have such a sharp increase in US interest rates, emerging markets normally suffer. Capital comes out, investors come out, the economy slow down. That's not happened this time. And that's because of a lot of the reform that's happened, a lot of the improvement in the underlying economies, a lot of the structural changes, and a lot of these economies have become much more self-sustainable, dependent on their own demand rather than relying on exports. So you've not seen fiscal situations blow out, you've not seen currencies blow out. So I think as we see the world rebalance over the next few years, there will be a very interesting shift towards the emerging markets, reflecting the growth, reflecting the potential, reflecting what the future looks like, at a time when Europe has challenges of its own, which will take a long time to be addressed, if they're ever addressed. Japan has its unique situation. So as you look at large pools of businesses, large markets to allocate to globally, I would say the emerging world is one that should stand out.
Fantastic. Would you, equities versus fixed income, would you still be overweight equities at this point?
I would be overweight equities.
Yep, okay.
I would be overweight equities. And as I said, I think that the point about monetary policy, when we look at companies around the world, growth is still fairly robust. Demand is still fairly strong. And you've seen that in the jobs numbers. So I'm not as optimistic about the scope for monetary loosening as some are.
So, I mean, US is front and center. I was just looking at the questions that the audience has submitted. There's a Slido for you to ask questions on the screen. And a lot about the US. I mean, there's one question: how much will different US political outcomes impact the trajectory of markets and how we should invest? Another question: will it be wise to withdraw investments before the US elections and to reinvest after the elections settle down? who was this? No, I'm just kidding. No, and then another question was: how is the impact of US elections to the market? Will Trump be better for markets? So I was gonna do this at the end, but I know you guys are all curious. So quick fire question, one word, that's it. Don't explain. Trump or Harris? Manraj. Trump. Chunyan. Trump.
It's a close race, Trump.
Trump, okay. I'm going to go against the grain and be contrarian. I'm going to call Harris then, just for the sake of it, so we have a bit of balance. But in the morning session, everybody called Trump, and I again went contrarian and said Harris, and I was the only one. It's surprising. In the investment world, especially here in Asia, dominant position is Trump is going to win. So with that, it's going to set up a question for you, Chunyan.
I think the market has priced in Trump victory.
Has it?
Yeah, that's what we have been receiving in terms of messages. But.
Okay. But I mean, the US presidential election, just like trying to time the market, is a futile effort. It's a 50.001, 49.999 vote, not 51.49 anymore. So literally no one can predict this, even in the US. But, post the elections, do you feel that it does make a difference who wins? And then is it actually going to impact the Fed and their policy? Which is very important for us, as Manraj correctly explained to us. Yeah.
Sure, I wish I know the answer.
The humility again.
There was a research paper that came out just to show that one of the best, most reputable research companies came out with this, that if Trump wins, that will be net positive 5% to upside to the capital market. If it's Harris, it's a negative 5% net. It just shows you that it's a very close call, plus minus 5. So it's tough, but
That's the margin of error for the polls as well, plus minus 5%.
But if you look at the, what do you call that? The best outcome, maybe. The best outcome is that, if Trump wins, but in terms of the government, there'll be split parties, then we have a balance of power, which looks like it could be the outcome. If that's the case, it could be net positive. Trump says a lot of things, but, judging from what he has contributed to the society last round, we don't think everything he said was as reinforced down to the T's as much as he promised to be. So might not be as stringent as people expect him would be. In terms of the monetary policies, it's actually not that restrictive in U.S. at this moment in time. So we think it will not have a drastic impact to the market. To be honest, the whole year, most of the retail customers, as well as instis, you can see that we definitely overweight equities against fixed income almost everywhere, just judging from how fixed income has behaved the whole year. But towards the end of the year, most of people will be taking profits. That's why sometimes it's a bit of a correction in the global equity markets. That might be a good approach to take. Now we are getting to the 11th hour and the outcome is so close. Do you want to be neutral or you want to have a very high conviction? And I think at this point in time, I don't think anybody has a very high conviction in terms of either direction.
Yeah. Anu, maybe follow up with you. What's your view, and does it make sense to be out of the market?
Definitely not. I would say we take a neutral view, and that's why, even though that was a point I was alluding to earlier, the environment still remains positive for equities, but given all these uncertainties that can come about as a result of the election outcome, it's a good time to be more neutral, but staying out of the market is the worst thing that one can do. Now, in terms of how we are advising our clients, which count amongst themselves all the big institutions in the world, we are not suggesting any changes to their strategic asset allocation in view of the upcoming election. Because one is what the candidates are talking about today, but the other is what kind of policies actually get enacted. And as Chunyan mentioned, how effectively can those policies really be implemented? So instead of trying to guess what could happen, it is best to take a wait-and-see approach, where you see how the actual policy enactment is happening, and what kind of long-term impacts will it have on different asset classes. And accordingly, at that point, we will be closely monitoring and making changes to any asset allocations. Now, just a brief sort of comment on how we think the markets will react. So if Harris were to win, we think it will be more of the same, a continuation of the existing policies, and the overall impact to the market will be somewhat muted. But if Trump were to win, it could lead to a lot of volatility, both on the upside and the downside. So if the markets focus on the tariffs, and he does come through in terms of imposing the type of tariffs he's talking about today, that is net negative for equities. But at the same time, lower taxes, looser regulation, that is a net positive. So it's really hard to say at this point, and we would just say be neutral, and you can decide depending on the rollout of policies as and when it happens.
Yeah. The number of questions after the US that is the highest is China. So there's a question, historically, China's stimulus package is characterized by short-term market spikes and subsequent declines. How is this stimulus different from the past? There's been a lot of conversation around China, whether it is investable. Historically, it's seen large peaks and troughs, but not much predictable behavior. Could the time be different, and why? So, and there's questions about BRICS as well, but specific to China, we can't not talk about China. And so, Manraj, over to you to tackle this difficult task of deciphering China and what should we do?
Well, it should be a whole panel in itself.
I know, yeah, you can talk for a
but
whole
it's
hour.
Interesting,
Yeah.
a year ago you do a conversation like that, China would be the first thing you talk
Precisely.
about. Now you can go through a whole conversation and not even talk about
maybe
it.
that's telling us something.
That is indeed. So I would say China for us continues to be a disappointment. I think the policy announcement over the last few weeks, whilst necessary, whilst helpful, demonstrates that the authorities and the policy makers do not fully appreciate the gravity of the issues structurally and in terms of sentiment and that they are beginning to address them a bit late. And you know, you've read about the various measures. I won't go into them, but I think what it does signal is a clear determination to hold up sentiment, to hold up the market. So you should expect to see further policy measures that will be introduced over a period of time. And given the amount of measures that have been introduced, given the amount of political capital that has been invested in these announcements, more will come. And if the market doesn't respond to these measures, I think you will see a greater level of desperation. But leaving the markets aside for a second, I think the real challenge for China is that domestically there is a transition going on. We're all aware that there's a political transition going on. That transition is not complete. There's a socio-economic transition going on, which is the most important one. Common prosperity is the mantra. The model of growth that China has followed in previous decades is not the model of growth that the policymakers want to follow going forward. That means that certain industries, certain sectors, certain ways of doing things are not going to be supported in the same way that they have before. And the challenge that poses, leaving aside capital allocators like us, leaving us aside for a second, is on the ground, the compact between the leadership, the business community, and the broader population has been stretched and damaged. The level of understanding and the level of trust in what the new model is no longer the same as it was before. And that means it's very difficult for businesses to make decisions. It's very difficult for entrepreneurs to do the sorts of things they would have done 5 or 10 years ago. It's bringing about retrenchment in terms of consumption, wages, any number of indicators you look at, and a lot more competition. So it is a very deflationary backdrop. And I think, as we've seen in other societies, once you have that, it takes quite a lot to revive the natural mechanics of the economy and to bring about better sentiment. So, you know, going back to the markets, you mentioned the snap that the markets have had in the last few weeks, Sam. I think that is notable, but we're still looking at very, very low valuations. And I think a lot of the interest China has seen in the last few weeks has really been from investors domestically, perhaps in the greater China region. I don't get the impression the broader pools of global capital are really convinced that this is enough.
Got it. Fantastic. We have a lot of questions from the audience, but I'm going to wrap it all into a single question for you guys to answer. There's a question about long-term asset allocation, 20, 30 years. There's another question about your personal asset allocation. There's questions about crypto, commodities, silver. You put that all together, right? So you guys can design an asset allocation, strategic asset allocation portfolio for the next 20, 30 years. How would your asset allocation look like? Public equities, fixed income, private equity, private credit, gold or silver, commodities, crypto included, okay? So very quick answer off the top of your head. Who's going to go first?
That wasn't in the script.
Sorry? You just give it to Endowus, is that what you said?
Okay, I can go first.
Yes, you go.
Okay, so assuming
you have access to all assets, yeah.
Okay, but you have to set sort of a model point. So if you are in your 30s, so you have some runway to go.
No, it's for you. It's for you.
For me.
Yeah.
Yeah, so if you're in your 30s.
I thought you were in your 20s. What's going on?
Okay, so I will do half of that in equities and about 40% in fixed income and 10% in alternative assets. That includes privates and others.
Okay, got it. Second.
So yeah, maybe I'm in my 40s. I hope I look younger.
You
but
do not look 40s.
So I think, yeah, I mean, as I said, like the way I think about my portfolio is I need a short-term liquidity to meet my operational needs, and then I keep a long-term portfolio where I don't want to touch that, and I do not definitely, I make sure that I don't have to liquidate that portfolio, any of the assets in that portfolio when I don't want to. Yeah. So that's the approach I take for managing my personal finances. Now, the short-term one is not very interesting. It's more like it's trying to meet my liquidity needs. But the interesting one is this long-term portfolio that
How
I'm
does that asset
focused on.
allocation look like?
So that one is actually, I would say, it has real assets, equities, fixed income, endowment policies, and some private credit.
Private credit, okay.
And
got it.
yeah, because we are homeowners, we tend to be homeowners in Singapore, so real assets represent a pretty large chunk of my portfolio. So I would say 50% of my portfolio is in real assets and private markets. The remaining half is right now.
And if you break down the 50 as 100 in your financial assets?
Oh, so basically my total portfolio, the
Yeah.
growth portfolio, I have 25% equities right now, 25% fixed income, 50% is real assets plus private
Okay,
markets.
got it. Very transparent, Anu. I didn't expect that. Didn't want you to go so personal, but it's great. Thank you. Manraj, wrap up.
Yeah, and I'm definitely not in my 30s.
You look it though, yeah.
I'll tell you what I do. I have about half my portfolio in public market equities. I have about a third in private equity and the rest in venture.
Yeah,
Full stop.
amazing. Guys, we should be very thankful because they represent a lot of the best of Endowus, transparency and humility. That's what I saw today. So please put your hands together for a wonderful panel. Thank you. Thank you, guys.
Thank you. Thank you so much.
All right, big thank you to our wonderful panelists for your invaluable sharing today. Thank you so much, Anubhuti Gupta from CFA.